Welcome back, stock traders. So let's get into the stock market. We're going to cover a few things. I'm going to try to keep this one short. There's not a whole lot going on today, but I do want to point out a few things, and let's get into these charts. Again, we let the charts be our guide. We don't follow, I don't follow headlines here on this channel. So ultimately, I follow more of a technician standpoint where I feel like charts price in the headlines. And so that really, whatever the charts tell us, that's what we continue to follow. So here we go with something I want to point out, actually, what I had. This BND here. Something's happened in the bond market recently. We're getting some pretty impulsive selling for bonds. You can see, gapping down and continuing to sell off. We haven't seen this kind of a move for a while now, really going back to about June. We really haven't seen this kind of a move, this entire rally, since the Fed stepped in. And that's, there's been pullbacks here, but we're getting some impulsive gap downs here in the bond market. So it's not necessarily a red flag, but it's something to watch. It's something that if this continues, I'd expect this to start to have some sort of an effect on the stock market. Now, is this money coming out of the bond market looking to go into stocks because the fear is fading? That's possible. Or is this money looking to go to cash? I don't have a good read on what this means right now, but the last time we saw the bond market sell off really was back here, back in the March, the March chaos where the bonds just collapsed with the stock market. And that's not good. Anytime you see the stock market and the bond market collapsing at the same time, ultimately that's really bad. So now take into consideration that as bonds sell off, the interest rates are rising, and that is not good for a stock market. Rising interest rates, there's a lot of debt out there, and there's a lot more corporate debt. I mean, there's just a lot of debt basically, and so rising interest rates will have an impact on that debt and the ability to service that debt. So just something to keep an eye on. Let's flip over to tech. Tech is the market for the most part. And the buyers stepped in just like I thought they might do. So yesterday I pointed out that there's some things brewing in the market. We're starting to see some of the stocks losing momentum. Some of the COVID plays are starting to lose momentum. And we saw big tech sell off right down to support. And I said yesterday that, look, this is the area the buyers should step in. If they don't step in and there's a gap down, then there's a problem. But again, the buyers did step in. So it really wasn't anything to trade there, except, you obviously could have gone long. You were at support, and that made sense. So logically, you can see they've just been buying it at support the entire time. Now they've bought it, this is the 8th time, I believe, that they bought it, and so it's getting a little long. This trend is getting a little extended. Doesn't mean it can't continue, but just something to watch for. Now, if we look at the daily, you can see we still have negative divergences here on the daily. They continue to build these negative divergences. These basically signal, a trend change is pending, or pending a sell signal. And just like we had right here, back when we had this big crash, we started to put in negative divergence, and then we got the big trend change. This one's been a lot longer. It's been extended. And that's primarily, I think, due to the Fed pumping up the markets, reinflating the markets. But the momentum's starting to fade. It continues to show that it's weakening, although we have no sell signal. And that's the thing. You have to wait for a sell signal. So going back to the hourly, we just have a run down to support, a bounce off of support. Now, where do we go from here? We're really in the middle. We're kind of in the middle. And I've started to mark out these two tops right here. Now, these are only 2 data points, but the potential is gaining for a bearish rising wedge. It's not a bearish rising wedge yet because, again, we only have 2 data points, so it's not a valid trend line. It is a divergent high right here. This is a divergent high where you have higher price and lower momentum. But we just had a bounce off support. That's basically all that happened. Moving over to the SPY. I do have a bearish rising wedge on this one marked out. Not a huge wedge, but it is coming. You can see on the hourly, we've got several reactions along the bottom here, reaction here, and then we broke, and we've been actually just back testing all day. You can see that today they tried to gap it up and over right here, but ultimately it's just been back testing and rejected. Back test right here, reject. So, you know, they could gap it up tomorrow and easily just recover this bearish rising wedge. But it is a pattern that does typically play out to the downside. We broke the wedge yesterday, back testing. Now you should see a rejection. Doesn't mean it's going to happen though, because without the Qs failing, going back to here real quick, unless this breaks, you know, this could easily come down and tag resistance again, support. But unless it breaks, you're not going to get the big move. The big correction is not going to come until this breaks. So that's really what you have to wait for. Let's look at gold here. I don't think gold's done selling off. You know, we had that one day yesterday, pretty impulsive. Gold was down like $100. I don't know exactly how it closed, but down pretty impulsively. And today we're getting the dead cat bounce is what it looks like. So here's your bounce back, and now it's starting to continue the rollover. So again, I think gold comes down to this 1790. You know, we could chop around, consolidate, might not do it all at once, but I do think we're going to eventually end up seeing prices around 1790 in gold. And just showing you, let's go to the weekly. I'll just show you where that support comes from. It comes all the way back from 2012, 13. That was really the end of that last bull market, and we broke above it, but it should be support now. So I'd expect us to come down and tag it, retest it, and then, you know, move higher there, or we could even come down a little bit lower. The trend line that I see on gold, it comes all the way back. It's right here. It goes back to the, you know, lows right here, and you can see we're starting to make a trend. The big crash there in March in gold prices brought us right down to there. And so we've got this trend now established, which I think really correlates to the longer term bull market trend line. So I could see gold coming back down at some point in time and just tagging that trend line. And that'd be where I'd want to be. That's where I'd be stepping in to buy. Again, everything in this video is just my opinion, not trading advice. Here's Barrick Gold. You know, they're just a lot of these gold miners are going to trade pretty much the same way, and they're proxies for gold bullion. But Barrick Gold, you can see, came down, tagged that support line that I had marked out. It was marked right there at 25.92. That looked like the first level of support. We came down and tagged it, bounced off of it today, and now we're heading back down to it. So I think it'll probably break, and that sets us up for the next level of support. Really, the next level that I see, we do have a little bit of support right there it's right about there. I'll have to tighten it up and see. It'll help if we have a reaction, but maybe right around $25, we'll say. But I think we're going to head lower. And then we also have, you know, kind of major support right here at 22.52. So I think we're probably going to end up at 22.52 sooner rather than later. Okay, so that's the gold trade. And here's XLV. We've got a bearish rising wedge here, and you can see what happened. Here's your bearish rising wedge in XLV. That's a bearish pattern that should resolve to the downside, but you have to remember how these algos think. These patterns, they find these patterns, they see them, and then they try to trick everybody out of the patterns. Ultimately, I think these patterns still play out, but you see a lot of tricks around the pattern resolutions, and that's what we had right here. So there was a breakdown in the pattern. It looked like, okay, this was about to roll over, and then today they gapped it up and recovered the bearish rising wedge. So I think it's now free to break down. If it breaks down again, that's probably the real deal. But until then, there's no sell signal on this thing. And this is just an hourly chart, so you can go ahead and mark that out. Measured target is probably going to be down here around 97, somewhere right around there. Here's XOK. Now, XOK, you know, is tech, and the Qs has not broken down, but XOK might have broken down. We have to wait to see if there's a rejection here. But here's the trend line I have on XOK. This is an hourly chart, but it goes back basically to April. Lots of reactions along this trend line. You can see They broke down right here. They actually recovered it. And so that was a bear trap. All this price action was a bear trap. They recovered it, and then they started to break down. So let's get right into the price action right here. You can see yesterday we broke down, and today looks like a back test. Now it might be a recovery, which means that this was another bear trap, or this might just be a back test that they're going to close right on resistance, basically. You know, this is resistance because we broke down. So until it's proven that this recovered, you have to treat this as resistance. And it looks like they're probably going to just close it right there, keeping everyone guessing. And then you'll wake up to a gap down tomorrow or a gap up. But ultimately, they're not. It doesn't look like they're going to let us know which way it's going to go. So, you know, I think you have to treat it as resistance. However, this trend line has been strong, but we did break down yesterday, and this is closing right on it. So you can't say it's a recovery. You have to say it's, you know, just closing at resistance until they recover that. Same with Apple. Apple, to me, I think is going to roll down to the bottom of this trend line. Here's why. We were trading up above this trend line right here for a few days. We broke down yesterday, and then they did the back test, and they've just been holding it right here. But we've already been up here. So because it broke down, this I think is the same deal where it's probably closing right at the trend line. I could adjust my line, you know, off. I might be off slightly, but it's basically right there. And we broke down. So it's resistance. We're going to close at resistance. Maybe we open to a gap down, and then this thing sells down to the support channel right here. And that's what this thing's been trading in really the entire time, is this price channel. So just watching to see what that does. Again, probably going to wake up to a gap up or a gap down. Nobody really knows. And the market's closed. So, yeah, they pretty much closed it right at the trend line. Microsoft, you know, false breakdown right here. They broke that, and it didn't really, I said yesterday, this doesn't have any business really being back down in this area. But today, gapped it up and ramped it back up. So, looks like a save there. Ultimately on Microsoft, I still think it looks weak because you broke this trend right here. This was the trend that it was in. But again, it's you know, it's pretty choppy. You know, we broke down here, we chopped back up and held support, then we sold off, then we're moving up. It's, if you look at it from a swing trader perspective, you know, you're moving down, you're moving up, you're moving down, you're moving up. So it's chopping around, and that's what you see when volatility increases a little bit, and you're starting to get some kinks in the armor. You know, usually doesn't go all at once. It takes some time, and you get some chop. So I don't know. I think this breaks down more, but you know, again, it's chopping right now, so we have to just continue to watch it. Amazon's above support, has not broken support. Until it breaks support, it is bullish. Google has not broken support. Well, it did break here, but it was a false breakdown. And it broke yesterday, but they recovered it again today. So it is still above support. It is bullish until proven otherwise. And it's not really bullish. It's just sideways. It's just sideways chop. Could be a topping pattern where we're just, you know, not moving up but not moving down. But it's not bearish. It's not. So we haven't broke the support. So that's really all I have to say about that one. And Tesla had a ramp, kind of pump today, pretty much on nothing. They did a stock split, which is silly that all of a sudden, because they're splitting the stock, people think it's worth more. It's really just, this is just momentum traders. You know, that's all this is. It has nothing to do with the actual intrinsic value. But you can see where they closed it, right at resistance. 1551, I've had this line marked out for a while. That's the gap that was put in all the way back here. I successfully had this trade. I caught this big sell-off here, and I've been out of the thing ever since. And for the most part, that's been the right move because it's just been a chop fest sideways. It hasn't really given you good swing trading price action. So we'll just continue to watch this. There's nothing else to really do here. It is at resistance, so could break higher, could break lower. Adobe started to break down the support line, but same thing as the other techs. Gapped it up, moved it back above support, so it's above support, but it's broken the major trend support. This is the major trend, the major rally. It broke that, and so now it looks like this is just the topping kind of pattern that you get before we start to reverse trend. But again, you want to see this break with conviction, this support line right here in Adobe. You want to see that break. And if that breaks with conviction and can stick, then that would probably signal a complete trend change in Adobe and look for lower price. PayPal closed at support right here. PayPal might break. You can see PayPal was up slightly today, but basically here's your support line on PayPal, and we closed right at it, so, or just a little bit above it. So again, they should step in and buy here. If they don't, and you see a gap down, then that might be the breakdown in PayPal that sets this this stock to the downside. Here's Philip Morris, and this is a weekly chart, so going all the way back to 2017. And I just want to point out what I'm seeing. So we'll wait for a weekly close, but you can see here, this is your bear market downward price action in Philip Morris. Had the false breakout right here, which was followed by a big impulsive sell-off. And now it's recovered and starting to march higher and broken back above resistance. So this is now support. If this can come back and do a back test on the weekly and hold, then I would say that's probably good for a breakout, and we'll look for this thing to go higher. If you look at the daily, you can see we had that back test on the daily. Here's the breakout, came back tested, held, and is starting to move higher, up another percent in a quarter today. So this continues to look pretty constructive, and I am definitely looking at possibly taking a position in this one. Here's Zoom. This is what I'm talking about, those momentum stocks losing steam. Little rally today, but the rally didn't recover the damage that was done yesterday. So technically the damage was done yesterday, and we're getting some kickback rallies. We could even rally some more tomorrow, but here is your trend line here, going back all the way to January. Just been moving up that trend line, and we broke, as I zoom in on the daily chart here, we broke that trend pretty impulsively, and today we just had a little bit of a kickback rally. But again, it only marched up to about the halfway point of the candle, and then started to sell off, closing down a little lower. If I go to the hourly here, you can see, here's your breakdown and a little kickback. So we could easily move all the way up here and back test this broken trend line, and I would expect it, to be honest. Yesterday, I was short this thing. I covered half my position. And what I'm looking for is to add back that half on a back test. So if it doesn't back test, I'll just ride the half position down to my profit target. And if it does back test, then I'll probably add back a full position. So this thing could easily go up another, depending on when it actually gets there, let's say 4% from where it closed. It could go up and do that back test and then roll over. But in general, the damage has been done on the chart. So unless they can recover this quickly and make this a false breakdown or a bear trap, then I think this thing's heading lower and probably heading down to this 178. That's the trade there. Here's DocuSign. You can see today up 0.7% basically, and pretty weak rally. It's been selling off pretty impulsively every day. And the rally today was really muted. So we'll see. This could easily do a kickback. I'm not short this. I'm not trading this. I've got enough stocks to watch. But in case anybody's interested in looking at this, you can see you're just continuing to break down. So expect back tests, but ultimately look for those back tests to be shallow and look for them to be rejected at resistance. Okay, I tried to keep it short, but it's hard to go through all these stocks. Ultimately, what I want everyone to just realize is, the SPY we closed at resistance. If I go back there, you can see we closed right there at this wedge breakdown resistance. Now tomorrow, do we gap up? Do we gap down? A gap up would be a successful recovery of that breakdown, and that would basically have been a false breakdown, and a gap down is a rejection of resistance. I'd put a higher weighting that we gap down or move or sell off, I guess, at the open and reject, but it doesn't necessarily mean that's what has to happen. So we just have to follow the price action and look for sell signals. We continue to I continue to expect the markets to roll over. However, this is a rally. Obviously, we've been rallying, and but I don't think we're in a bull market. I still think we're in a bear market rally. Although, in a bear market rally can test the all-time highs. We can probably even marginally break above the all-time highs. As long as it doesn't go too far beyond that, then I can still call this a bear market rally. However, obviously the Qs is not the market. That's tech. I'm talking about the SPY. When I talk about the market, I'm talking about the S&P 500. Okay, thanks for following along. Appreciate that. Leave me a thumbs up if you find value, and I'll catch you guys on the next one.